I'm Charlotte McLeod with the Investing News Network, and here today with me is Ben Finegold, who runs uranium research at Ocean Wall. Thank you so much for joining me online once again. Always good to see you.
Thanks, Charlotte. No problem. Happy to be here.
Great. And just before we get started, I was hoping you could give us a quick introduction to yourself and the work that you do at Ocean Wall.
Yeah, of course. Ocean Wall are a alternatives focused investment advisor. We are mainly focused on the mining and metals space, of which uranium is really our core focus. We also do some work in the lithium space, the rare earth space, and some other sort of niche alternative trades. We do some work in Venezuelan sovereign debt. We do some work in the psychedelic space. So sort of the corners of the market perhaps that have been overlooked that perhaps need some more attention, of which uranium is definitely one of them. My role here is focused on research and sort of trying to tell these stories to people in a way that hopefully makes sense and sort of resonates with them. But, we do some work with corporates, also, more on the institutional investment side as well. But no, really, we've been on the uranium trade for sort of 4 or 5 years now and have built a brand really around uranium.
Okay, really good to have that context. Now, our last conversation was toward the end of last year, I believe in October. And at the time, talking about the uranium cycle, you thought we were in about the second or third inning, so still pretty early. I'm wondering how you think it's progressed since that time.
Yeah, I mean, I think, with these things, it's always, when you're talking in metaphors like innings, I guess the question is how many innings are there to set some context for where we are. I think if I sort of maybe use a slightly more useful analogy, I still think we're early. I still think we're very early. I know we'll sort of get on to whereabouts really think we are in that cycle. But I think if we can split it up maybe into three things, we talk about equities, talk about the spot market, and then obviously broader nuclear sentiment. So if we start with equities, we use Cameco and the Sprott Physical Uranium Trust maybe as a reference to begin with. When we last spoke, Cameco was trading at about $21. We've seen a 30% increase in that to over $30 today. And Sprott was just off its lows, I think, but it's still about 20% off its all-time high today. I guess on a broad sort of perspective, our internal uranium tracker shows that the entire equity universe of the uranium space is up about 27-28% year to date. Just to put that into context, the entire uranium equity universe is about $40 billion. So we've seen around about $8.5-9 billion added to that sort of since the start of the year. On the spot price, those who have been following it, they'll know that it's number one, it's difficult to track because there's really not many people that actually report these numbers. You've got Numiko and Trade Tech, but the spot price is up about 18% year to date. Interestingly, the sequesters like Yellowcake and Sprott that track this via their fund structures, they're lagging the spot price move. They're at about 10 to 12% up year to date. So they are lagging a little bit. They're at about 10% discount to their net asset values at the moment. On the nuclear sentiment front, stuff remains super positive. If I just sort of reference the last couple of weeks, I guess, the Senate passed a bill for SMRs at the beginning of June, and then also on Friday we saw EU ambassadors reach a landmark agreement, which is it's a renewable energy law that backs more allowances for nuclear. This was really a follow-up as well from the news that we saw at the beginning of last year, which was nuclear being labelled as green under their EU taxonomy vote. So I think if that sort of sets the landscape for how we look at equity, the spot price, the spot market, and also the general sentiment towards nuclear, it's all positive. And, our conversations with investors are, when they see price weaknesses, it's always refer back to that fundamental story, which is with all the bells and whistles around the uranium market, this remains a fundamental story driven by a long-term secular growth trend that is nuclear power.
Okay, really good overview to set the stage, as you said, for investors. I do appreciate getting away from those innings because, to be honest, I'm not a sports person, so very good. I do remember going back to that last conversation we had. You mentioned that the thing that would kick us into that next phase is institutional interest. So I wonder if you've seen more engagement on that side since then.
Yeah, I mean, I can speak from the advisory perspective. I spend a lot of my time around Europe, sort of, really speaking to these institutions about uranium and sort of the way that we're seeing things. Um, from a high level view, if I was having these conversations 2 years ago, the conversations could have ended pretty quickly back then. Today, people want to know the story. People are interested in the story, and also people are looking for that next commodity story. People are really looking for how can I capitalize off this huge transition to green towards electrification. There are certain markets, especially in metals, that are becoming increasingly saturated. And uranium is not one of them yet. And that really is a function of us being early in this. We wrote a couple of weeks ago about Parnassus Investments in the US. They're a $42 billion based, San Francisco based asset manager. And they've removed all restrictions on nuclear investment. So that's generally a trend that we expect to see accelerating over the next sort of, 12, 18 months. But, really throughout the long term, as people start to understand the power of nuclear in our journey to sort of to green the planet. But also there is this restriction in terms of the size of the sector. It's a $40 billion market cap. You add up all of the equities within the uranium sector, and it's only a $40 billion market cap, of which 53% is made up by Kazatomprom and Cameco, the two world's largest producers. So there's restriction in terms of liquidity. Asset managers, wealth managers, any investors really have their own liquidity restrictions, or in terms of, we're not going to buy funds, we're not going to buy companies that are less than X $1 million market cap. I mean, if you have a restriction of, let's say, $250 million of what you're allowed to buy, you can only really buy about 18 to 20 names. So as the uranium story accelerates, as the nuclear story accelerates, and as the uranium story starts to gain more mainstream traction, we think that it's going to really start to catch the eye of institutions. And I can really speak from the last 12 to 18 months, just through my conversations, that people are becoming a lot more accepting of this and starting to really understand that there is this metal that powers 10% of the world, 20% of the US, 70% of France. The Chinese nuclear growth story we'll get onto. But there's this amazing metal, and it's such a tiny market. And it's that dislocation that really, really excites us.
Yeah, really, really exciting to see that growing acceptance. Now, if we look over to supply, we still have the Russia-Ukraine war that's impacting the sector. And I believe there's a bill that would ban the U.S. from importing uranium that is making some progress. So I wondered if you could talk a little bit about that and the implications for the sector.
Mm-hmm. Yeah, I think, I was having a conversation actually today with a client, and it's really this point that you don't want to get drawn into the headlines. I mean, I'll sort of get to my desk in the morning and I'll filter in uranium, sanctions, Russia, and just have a sort of general check of what's happened overnight. And you do see these headlines where they say US to ban Russian uranium. And immediately, as a uranium analyst, I panic and I say, okay, I need to know about this. And then you actually read the fine print of these articles and these reports, and it's the US will ban uranium in 2027. And if it negatively impacts utilities' ability to be able to actually produce nuclear power, then we'll have to use Russia regardless. So there's a lot of big headlines promising a lot of things. I don't want to detract from what is really good intention. But I mean, I've just spent the last 2 months really compiling a report on Russia's stranglehold in nuclear markets. And the conclusion is that Russia are essentially in an unsanctionable position right now, not just in the US, but globally, in a way that they've gone beyond putting their foot in the door in terms of their involvement within nuclear markets. But they are so deeply ingrained in countries all over the world in terms of reactor construction, in terms of their fuel cycle dependency. I mean, Russia are doing educative initiatives in countries where they're building reactors. So they're really, it's not just implementing an energy source, that they're becoming wholly ingrained into the societal aspects as well. So in terms of that bill, it's great to see that they're looking at it. I just don't believe, based off the work that we've done at Ocean Wall and based off the work that a lot of other people have done, that this is something that can be fixed in the short term.
Right. I think it's so important to look at the headlines, of course, but also to actually read the article and find out what they're saying. And, that bill, from what I understand, doesn't talk at all about conversion and enrichment, which Russia is very dominant in. So I wanted to check in with you on that as well and see if we're seeing countries step up their efforts in those areas of the supply chain.
Yeah, again, there's only so much they can do, because they've been supplied by Russia for so long. Um, if they were well supplied, if they were well covered in terms of inventories, like a lot of European utilities and also some Chinese utilities, then they can look for alternative supply elsewhere. But really, it's not out there. Again, this report that I just finished looks at if all of these if all of the countries, of which there are not very many, there's about 4 in enrichment and 5 in conversion, they all went to nameplate capacity, and you remove Russia, there would still be about a 25% deficit. I mean, there's some estimates that if you wanted to remove Rosatom from the conversion and enrichment markets, it would take 7 to 10 years. That's because building or licensing, these facilities, it takes a long time. Even just employing the people who are dealing with what's deemed as Class 7 material, radioactive substances, hiring the employees for these plants takes a really, really long time. Europe is definitely further ahead in terms of their ability to be able to diversify away from Russia. So, we've seen a landmark deal between Cameco and Enejatom in Ukraine, for example. They're also supplying in Bulgaria. There was something that came out in March from the Czech Republic, who have signed a deal with Westinghouse to replace TVEL, which is a Russian fuel supplier. Spain and Slovakia are also looking to diversify out of Russia in terms of their fuel supply. I mean, Westinghouse is obviously going to be a key beneficiary of this transition away from Russia. But there's a lot of these VVR 440s, which are the sort of smaller reactors, dotted around Europe, which Westinghouse didn't originally have the fuel supply for. Now they're advancing efforts to be able to actually produce this fuel commercially. So that's an interesting aspect to keep an eye on. I think in the US it's a completely different story. This really sort of dates back to the early 90s, which was a program called the Megatons to Megawatts. It was an agreement between Russia and the United States, which was to convert about 500 metric tons of Soviet-era weapons-grade uranium down to 15,000 tons of low-enriched uranium, which could obviously be serviceable to nuclear reactors. This was 10% of the US's electricity for basically 20 years. They investment in their domestic enrichment and conversion facilities, especially enrichment, stagnated massively. They basically became solely reliant on Russia for their nuclear fuel. And this is not something, when you do that for 20 years and you build that level of complacency, it's not something that you can change overnight. And, as I said, these things take so long to construct and license. And ultimately, it goes back to this point about sanctions, that it's not something that I can see happening, that I can see being implemented in the short term. And ultimately, it won't affect the equity markets or probably the spot price until we see a firm date on an actual removal of Russian conversion and enrichment within the nuclear fuel cycle.
Okay, really interesting, and appreciate hearing about that difference between what's going on in the US and what's happening in Europe. So, supply, definitely very tricky. One final note on supply that I wanted to ask you about is, to what extent are we seeing companies bring supply back online that they might have taken off during times of low prices?
Yeah, so I guess the reference here really is to sort of looking at Kazatomprom and Cameco again as that benchmark. Kazatomprom had issues post-COVID, during COVID, getting issues with sulfuric acid, getting access to sulfuric acid, which is obviously one of their main components of the ISR method, which is what they use to extract uranium out of their Kazakh mines. We've actually seen a twofold increase in the price of sulfuric acid. but they've also had difficulties, which they've been very open about sourcing certain equipment needed to successfully mine uranium in Kazakhstan. They are currently operating at about 20% below nameplate. That was the same in 2022. They're going to go to about 10% below nameplate next year. But again, this is all to remain consistent with this sort of market-centric strategy. It's this post-Fukushima era of supply discipline, and we are not going to increase our production without firm commitments from utilities or from whoever wants to buy it, whether it's financials or utilities. We're not going to make this huge capital commitment to increase production without knowing that we're going to have a home for our uranium. Cameco, at the end of last year, there was obviously the restart of MacArthur River and Key Lake after 4 years being shut down. The plan is now to get them back up to 18 million pounds per year on a 100% basis. That should be starting in 2024. But, both of these companies have been super clear. Sentiment is good towards the market, but it's not at a point yet where they can say, okay, we're going to start going gung ho, and we're going to start operating at 100% of our nameplate production. But also, you don't necessarily even have the choice if you're someone like Cameco, because your marginal cost of production is still $30 off the current spot price. So you have an element of choice, you don't have an element of choice, but we expect to see production estimates grow. Whether or not they're operating at 100% of their ability to produce, we don't know yet. But again, the overriding theme here is that there's going to be more demand for uranium, and that's becoming very clear.
All right. And that leads in well to my next question, which is, if you put together these supply and demand dynamics, the outlook for uranium looks very positive. We have the spot price creeping up to that $60 per pound mark. I think a lot of people are wondering, how high does the spot price go in 2023? So curious to your thoughts on that. And as well, will it be this continued slow and steady rise or something else?
Yeah, I think it's a fair question. It's one that we get asked a lot, because it's so easy to look back at 2007 and say the environment then was actually less supportive than it is now, so it's going to happen. Now, we take a slightly different view, and we'll sort of get into that. But I think to give you a sort of a more broad overview of our thesis, and then we'll obviously get into some pricing. The nuclear trend is a long-term secular growth trend that we believe is going to last over the next 10, 15, 20 years. These reactors have got 100-year lifetimes, some of them. So this is not a boom or bust necessarily scenario for uranium pricing, because we're not dealing with a boom or bust energy source. We're dealing with actually the antithesis of that. Ultimately, there's going to be some volatility along the way. I mean, if you look at a uranium price chart, that there is obviously high levels of convexity in uranium pricing. But in 2007, there was a single black swan event, which was the flooding of Cigar Lake, which wasn't even online yet. It was meant to be 10% of global production. And this is what basically catalyzed a 7 times price increase in uranium. We think the market's, as I said, more optimistic now. Scott Melby at UEC actually said to me, to Ocean Wall, he said, in the last bull market, half the world hated nuclear, was against nuclear. So today is a lot more supportive of an environment. But there's just a couple of things that we think have maybe been overlooked. We think, number one, the Chinese growth story is being deeply unappreciated by the market and undervalued. At the latest Kazatomprom AGM, 91% of shareholders approved a long-term contract between Kazatomprom and CNNC in China. And this approval allows for further transactions between Kazatomprom and CNNC of 50% to up to 200% of the total book value of Kazatomprom's assets. So that's potentially 10.4 billion in uranium purchasing. China are going to build more reactors in the next 15 years, and it's been built globally in the past 35 years. Again, they already account for about 35% of Kazatomprom's revenues, China. So this Chinese growth story is like nothing that we've ever seen in nuclear markets before, and they're also doing it. They're not talking about doing it, but they're really doing it. I mean, you can look at one of the classic cases against nuclear is these long build times and, cost overruns, billions and billions in cost overruns. China are doing it. They've said they were going to do it, and they are doing it, and they're looking at building 8 reactors a year potentially. So we think the Chinese growth story, it really deserves its place in this argument, and really front and center of this argument. Plus, you have massive growth stories in Russia and India. India is now the most populous nation on Earth. They're looking at building 8 new reactors. So you've got those huge demand drivers on that side. And then you have this slightly separate geopolitical swan, we'll call it, which is this Russian dominance within nuclear fuel markets. Again, to go back to this point that it could take 7 to 10 years, it could take up to a decade for us to remove Rosatom from nuclear fuel markets. And then also, that's an important trend that we really want to keep an eye on, is this ability for countries to be able to diversify away from Russia, and to what extent they actually can. And then obviously from our point of view, and from your viewers' point of view, how is that going to inevitably impact spot prices, equity markets, and the likes. But I guess conjoined to the geopolitical thesis is our transport thesis, which is that the St. Petersburg route from Kazakhstan via Russia to the US remains available. And that's first and foremost, the St. Petersburg route remains available. About 50% of Kazatomprom's exports, so about 20% of global supply goes through that route. They've been looking at a Trans-Caspian route since 2018. They've had some successful deliveries, but they've been unable so far to increase their quota to a level at which, if St. Petersburg did become unavailable, the Trans-Caspian route would not nearly be able to satiate the level of supply that Kazatomprom would have to run to the west. So we think that is a potential bottleneck with significantly higher associated cost, obviously, than the very simple route which they run now, which is from their mines up to their northern neighbor in Russia and to St. Petersburg, all done on one train and then shipped across to the US. Now, just very quickly on that, there used to be between 3 and 4 different vessels that ran the route from St. Petersburg to the United States. There's now one, a company called ARRC, Atlantic Railroad Carriers. So again, we're seeing this reticence to actually run that route. As far as we're aware, uranium is pretty much the only Russian labeled commodity actually being allowed to arrive in the US or on Canadian shores. And again, it's this idea of, it's not oil, it's not natural gas, there's no pump, there's no tap where you can turn on and off uranium. It is this complex supply chain of which every single component has to be working at once, and even when everything's working at once, we were in a £40 million supply deficit last year. So imagine what could happen if there was further disruption along that network. So that's something that, we're definitely looking at. And I guess it's an amalgamation of these things with this overarching banner, this sort of overriding theme towards nuclear, that we think is going to support higher prices. In terms of putting a number to it, I always give the reference of the US bought new pounds from Encore Energy and UEC at the back end of last year. This was about $60 to $70 a pound. So that was at about 40% premium to current prices at that time, which was around $50 a pound. I think, one thing for us to look at, and it's something that we really talk about in our conversations, is that there is definitely some resistance and there is a floor at about $48 to $52. So, I think all investors, when they're doing their risk analysis of these trades, they're looking at upside versus downside. And really, we do see limited downside to the trade at around $55, $56 a pound, because we have seen such strong resistance at sort of that level. I will give you our numbers, which is, we think about $60 a pound by the end of this year, $75 a pound by the end of 23, and then sustained higher prices above $80 a pound thereafter. It's a very, very difficult price to model because there's so many moving parts, and also, it's such an opaque market in terms of utility demand, financial demand. So putting exact numbers on it is difficult, but we think that those numbers are fair.
Right. You certainly start to see, just listening to you talk, how complicated it can get. And as you mentioned, it's a really opaque market, and we talk about the spot price a lot. That's what people look at. But really, it's the term market where a lot of the uranium deals, or the bulk of them, really are getting done. So I wondered if we could spend just a little bit of time talking about that, and if there's anything you can update us on there.
Hmm. Yeah, again, even for us doing this every day, it's difficult to get this information. It's a super opaque market. There was a report out from UXC, who are the main industry consultant, titled "Uranium Term Market Enters a New Phase," and this is definitely something that we believe to be happening. So last year there was 125 million pounds contracted in the term market in the first 5 months of this year, and bear in mind that was a 10-year high. In the first 5 months of this year, there was 107 million pounds contracted in the term market. So the expectation is to break last year's volume with ease. It could already be broken. Those were the latest numbers from May. It could already be broken now. We're now sitting here sort of towards the back end of June. But one of the key things that they did mention is that there's very few US utilities buying via term contracts versus last year, which was about 60%. Now, there's always been this sort of understanding in the market, which is the European utilities were much better covered in terms of their inventories and than the US. So I guess that's somewhat surprising to see. The UXC also estimate that utilities are still uncovered for around 230 million pounds of U3O8 between now and 2028. So we don't see this slowing down. We think that the term market, we've always believed that the term market is going to be a key driver in this bull market, because it gives you this sort of crystal ball into the future of how well covered are these utilities, what price are they willing to pay for these pounds. And while some utilities prefer buying bundled products, for example, they buy UF6, they buy EUP, they buy U3O8 all in one package, around 70% of all of these term purchases are purely uranium, are purely U3O8. And, for us, this is the market that we really care about in terms of if you're invested in the sequesters, in terms of, the spot price does set that benchmark of sentiment, not only sentiment in the market, but also beyond sentiment, the real fundamentals that we've always spoken about, which is supply and demand. What is the output of this, of what we believe is fundamental economics? When is this going to impact the underlying assets? And again, I think we spoke about this last time, was that, we have some people say to us, this spot price is only up 15, 20%. Actually, the spot price is up about 250% since 2018. So, it's not like the price hasn't moved yet, but we just really believe that it's got a lot longer to go, and the utility feeling is certainly that there is this degree of uncertainty in a world without Russia, potentially without Russia. And I guess it's this uncertainty that breeds maybe some element of panic in the market, maybe not, but I guess, we'll wait and see on that.
Okay, thank you for going through that. And if we look over now to the uranium stocks, one thing that we also spoke about last time was how the universe of uranium companies has gotten pretty small. And in general, a rising tide lifts all boats. But I do think that people like to hone in and figure out where they can possibly get the best return. So wondering what category in terms of the uranium equities you find most exciting.
The answer is all of them, because it's such a small universe. And I know I've sort of maybe got my blinkers on here in terms of being a uranium bull, but again, a rising tide will lift all ships. There are so few companies to invest in this space. There used to be, in 2007, there were about 600 different names that you could own. And now there's about 78 to 80. So I think, look, you have to maintain a diverse portfolio. If you want to take the ETFs as gospel, which I don't think you necessarily do, but I guess it's a good rule of thumb. You want to have a high weighting to the two largest producers in the world, Cameco, Kazatomprom. You want to have a good chunk of your weighting, maybe 25% towards the sequesters like Spross and Yellowcake. So you really have that Delta One trade to the uranium spot price. And then I guess your fun, as we would describe it, is going to be in the exploration and the development stage companies. The exploration stage companies, it's very difficult for them to make a case that their method of uranium exploration is better than other people. I mean, apart from very few of them, it's a fairly innovation in terms of actually finding uranium has probably stagnated over the last 20 to 30 years. On the development side, however, there's some really exciting names, the likes of Fission Uranium Core, for example. If you look at them and a peer analysis versus someone like NextGen, I think it's an incredibly undervalued company, just on that basis, on the basis of Fission are a company that genuinely want to produce uranium. And I think there's a lot of companies in the space, and I think this is, I guess, part of the answer to this question is a lot of companies that maybe promise that they're going to, that their plan is to produce, but ultimately that they're not in the production game. They're in the, we're going to buy our assets and we're going to see how it goes, and we'll sort of kick the can down the road. Fission's not one of those companies, so I think they're an interesting one to look at. But if you're covered on those sort of four bases, which is you have sequester exposure, I would say a higher weighting obviously to the producers and the developers, and then obviously the exploration companies. It's very difficult to really know the value of those companies, but they're definitely there's a few that's worth owning.
Okay, an interesting point again about the distinction between companies that truly want to produce and those that might be hanging back a little bit to see how it goes. So again, when it comes to the stocks, we have seen them move along with the price, as you've mentioned. I don't think that it's too late to get in at this point, but are we approaching that moment when it is a little bit too late?
I don't think so at all. Our belief is that when you look back at, let's take Cameco, when you look back at the Cameco 30% move year to date in the context of the entire bull market. So let's fast forward 5 years and let's say that this thesis has come to fruition in the way that we expect. Our belief is that when you look at this 30% move in Cameco, and in the exact same way that stocks were down 30%, at points this year or last year, when you look back at that, we think it will be insignificant. We think that the move in uranium stocks, in the uranium price, is going to be it's so highly convex that these moves are not going to play a significant factor necessarily in your portfolios. We really believe we're early in this trade. This is further evidenced by the size of the sector. There's just no way that, again, this something that can contribute this much to the global energy mix, and there's no substitute for it, can have this small a market capitalization versus other metals and other commodities that we look at. We're still about $30 shy of the Western break-even price as well. So if you just take it on a purely fundamental basis, if you are a believer, which we are strong believers, that Western supply is the only solution to supplement a deficit in the uranium market, then we need to see prices nearly double. So I guess that for us is you strip back everything in this trade, and again, these bells and whistles and these different black swan events, potential black swan events, and you strip everything back, prices have to go up if we are to supplement, if we are to fix this supply deficit over the next few years.
I think it helps to hear it laid out very clearly like that. And the last note I want to make on the companies is, do you think we're in an environment where we might see M&A in the uranium sector? I wasn't sure what you would think about that, given that the sector is, as we've talked about, quite small. So I don't know if consolidation is something we would see right now.
Yeah, it's a very fair point, because there's not many companies around for which M&A, where M&A can actually happen. I know we saw some cases last year, and it's kind of come to a halt a little bit in 2023. Obviously the landmark, the sort of flagship deal was the Cameco Westinghouse deal at the back end of last year, and really we're waiting to see a sort of cost-benefit analysis of that. Again, the Westinghouse deal you're going into a sector of the uranium market which is super capital intensive. I mean, mining itself is highly capital intensive, but nuclear reactor construction, it's a completely different level to that. So I guess we'll wait and see how that turns out. But yeah, I mean, generally we expect to see M&A accelerate within this space. Again, it's this idea that companies, when the stock price was 40, let's say the spot price goes to 80, what was worth X is now worth X times two. So, they do become highly attractive. So it's especially for the sort of larger companies, the producers and some of the large scale developers looking for that next project, looking for that next stage in the company's sort of evolution. What is going to be that next Cigar Lake, or what's going to be that next MacArthur River, or the next Arrow. So there's always going to be that appetite from these companies to try and find that, to try and find that generational asset.
Okay, this has been really illuminating in a market that often leaves us feeling kind of in the dark. So, any final thoughts that you would leave investors with as we continue into the rest of the year?
Yep. I think I'm going to go back to something that I sort of said earlier, which was around this 2007 boom or bust. And I think that the narrative within the uranium sector really needs to sort of detach from this 2007 boom or bust scenario, because it spooks a lot of people. And especially, when we talk about institutional investment being this next leg up, it's going to decrease the bucket of institutions that are interested in this sector because of that fear of the convexity and the volatility within the market. So I think the narrative around nuclear and uranium has to be this long-term trend that is ultimately going to be amazing for the planet, that's ultimately going to have to be one of these key solutions in what will obviously be a basket of different solutions. But we believe that nuclear has to be that baseload energy solution on the bottom of which renewables and hydro and other things will also sit on top of. I would urge everyone who's watched this to go and watch Nuclear by Oliver Stone. I went to the premiere in London. It's absolutely fantastic. I think it's just come out on different streaming platforms. It really gives you it gives an attention to detail on nuclear that I haven't seen, at least visually, before. And also this sort of call to action, which is almost stop looking for the next solution, because we have it. And we have this amazing, powerful, energy dense, low carbon electricity source, and it's here. So let's make sure that we understand that, and let's make sure that this concept of NIMBYism, not in my backyard. I understand it for people that don't understand nuclear, but I think that if you do the work on nuclear and that you really start to understand, again, this cost-benefit analysis, that it has to be a massive part of our future. We write about this at Ocean Wall. Oceanwall.com is our website. We publish all of our research for free. So please feel free to have a look at that as well.
Okay, perfect. I think that's a great note to wrap up on. Thank you so much for coming to share about what's going on in the uranium market. It was really helpful.
No problem, Charlotte. Thank you for having me.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this has been Finegold with Ocean Wall.